What is going on, traders, and welcome back to Explain the Charts. Today, on October 14th, 2025, we are taking a deep dive into GBPUSD, which has seen some very significant bearish action recently. We're going to break down the latest news headlines that are putting pressure on the pound, and then jump straight into the charts to see what the technicals are telling us. The biggest story right now is that GBPUSD has fallen to a 2-month low, currently trading around the 1.3250 mark according to the latest reports. This sharp decline is being directly attributed to weakening UK labour market data. Reports show that UK earnings slowed in the 3 months to August, and the unemployment rate unexpectedly ticked higher to 4.8%. This economic data provides ammunition for the doves at the Bank of England, suggesting they may continue to cut rates or at least hold off on any hawkish policy changes. In fact, the market is not expecting another rate cut until March, with only a 40% probability priced in for a December move. Looking ahead for the UK, we have critical GDP data due later this week, followed by inflation figures next week, which will be watched very closely. On the other side of the pair, the US dollar is gaining strength as investors await comments from Federal Reserve Chair Jerome Powell. These comments come amidst a US government shutdown, which has limited the release of other economic data. Despite this, the Fed is still widely expected to deliver another rate cut this month, with a third potentially coming in December. Adding another layer of complexity are the renewed US-China trade frictions, with tit-for-tat port fees ramping up tensions. This geopolitical uncertainty often leads to a flight to safety, which typically benefits the US dollar, putting further downward pressure on GBPUSD. Now, let's bring up the daily chart to see how this news is reflected in the bigger picture. Looking back over the past year, we can see a strong uptrend that started in early 2025 and peaked in late June near 1.3770. The price tested these highs again in mid-September, failing to break higher and forming what could be interpreted as a large-scale double top, which is a classic bearish reversal pattern. Following that second peak, the price has been in a clear downtrend. The news reports mentioned a critical breakdown below a multi-month rising trend line and the 1.3360 support level. We can see this very clearly on the chart. That breakdown occurred at the beginning of October, with two massive bearish candles on October 1st and October 3rd. That move took the price from above 1.34 all the way down to a low near 1.3090. After that sharp drop, the price saw a brief recovery, but ultimately failed to reclaim the 1.34 level, which acted as new resistance. The most recent price action shows another leg down, initiated by a strong bearish candle on October 9th, which has brought us to the current critical levels. The candle for October 13th shows some indecision, but the overwhelming momentum is clearly to the downside. Let's zoom in on this recent action since the September peak to get a better look at the structure of this downtrend. Here you can see the peak on September 19th at 1.3314. Wait, that's not right. The peak was higher. Let's check the data. The high on September 24th was 1.3427, which was rejected fiercely as shown by the long upper wick on the candle from September 25th. That was a major warning sign for the bulls. This rejection kicked off the sell-off, which accelerated dramatically when the price broke the 1.3360 support zone on October 1st. Notice how after the low on October 3rd, the price struggled and consolidated for a few days before sellers took control again, confirming the downtrend is still very much intact. Now, switching over to the 1-hour chart, we can analyze the recent price action with more granularity. Here we can see a clear series of lower highs and lower lows, the textbook definition of a downtrend. The breakdown below 1.3360 at the start of October is very visible here, with strong, impulsive bearish candles. After the bounce from the October 3rd low, the price formed a clear resistance level around 1.3480 on October 7th before the next wave of selling began. This 1.3480 level is now a key short-term resistance point to watch. More immediate resistance sits right at that broken support of 1.3360. Sellers who missed the initial move will likely be looking to enter short positions on any rallies toward that level. The immediate support is the recent low established around 1.3278 on October 9th. A break below this level would signal a continuation of the bearish trend. Looking at the most recent hours on this chart, we can see the price is consolidating just above the 1.33 level after the sell-off on October 9th. This tight range indicates a battle between buyers trying to defend this psychological level and sellers gathering steam for the next push lower. The price is currently struggling below the previous swing lows, suggesting the bears have the upper hand. Finally, let's drill down to the 15-minute chart to see the intraday action from the last session. The price action here is choppy, reflecting the consolidation we saw on the hourly chart. We can see the price attempting small rallies, but repeatedly failing to hold any gains, with sellers stepping in quickly. The session on October 13th ended with the price hovering around the 1.3330 area, showing significant weakness and a lack of buying interest. This posture heading into today's session reinforces the bearish sentiment and sets the stage for a potential break of the recent lows. Okay, let's pull back to the daily chart to recap and formulate a plan. The key price levels to watch are crystal clear. Immediate and critical resistance is at 1.3360, the old support level. A move above that could see a test of the October high around 1.3470. On the downside, immediate support is the recent low around 1.3280. The main target for bears, as highlighted in the news forecasts, is the 1.3150 zone, which represents a significant prior low. So, what's our unbiased prediction? The bearish scenario appears to have a higher probability, I'd say around 65%, given the confluence of negative fundamental news for the UK, a strengthening dollar, and the clear technical breakdown on the chart. A catalyst for this would be a clean break and hold below 1.3280, especially if Powell's comments are hawkish or UK data this week disappoints. A bullish scenario, with about a 35% probability, would require a strong reclaim of the 1.3360 resistance level. This would invalidate the recent breakdown and could signal a short squeeze. This would likely need a trigger, such as surprisingly strong UK GDP or inflation data, or a very dovish turn from the Federal Reserve. So, the key things to watch are the upcoming UK economic data, Fed Chair Powell's statements, and of course, those key technical levels we've just outlined. That's our analysis for today here at Explain the Charts. Please remember, this video is for informational and educational purposes only and should not be taken as financial advice. The Forex market carries a high level of risk, so always do your own research and develop your own trading plan before making any investment decisions. Thanks for watching, and we'll see you in the next one.